So just what will mortgage rates do in 2024? Heck, I don't know. I don't have that crystal ball. No, I'm just kidding. I do have an opinion, and I'll tell you what all the experts are saying about the 2024 rates. Hi, my name is Tim Hollenden. I'm the team leader of the Hollenden team with eXp Realty. And if this is your first time to this channel and you want to know everything there is to know about eating, sleeping, working, playing, the good and the bad of living in Louisville, Kentucky, then subscribe and tap the bell for notifications so you can be the first to know about the current real estate market in Louisville, Kentucky. We get calls, texts, and emails every single day from people just like you looking for help on making their move in Louisville, Kentucky, and we absolutely love it. Whether you're moving in 9 days, 90 days, or heck, even 9 months, give us a call, shoot us a text, or send us an email so we can help you make a smooth move to Louisville, Kentucky. So on to our video today. Before I even get started on that, I want to lay the groundwork with 3 definitions. And it's going to kind of give away the punchline, if you will, the joke. No joking today. In all seriousness, the federal funds rate is the first definition. Now, this is an interest rate at which banks lend to one another overnight to meet their reserve requirements. It's a key tool used by the Fed to influence monetary policy and can impact various aspects of the economy, including lending rates, which we're going to talk about today, for consumers and businesses alike. The second definition is the 10-year Treasury Yield. Now, the 10-year Treasury Yield represents the annualized return an investor can expect to receive on a 10-year government bond. It's a crucial indicator influencing interest rates across financial markets. And you can track the 10-year Treasury Yield if you're an analytic like me on your favorite financial news website or your favorite financial data platform. Finally, the third definition, and then we'll get on to the meat of the video, is inflation. Now, most people probably know what this is, but I'm going to dumb it way down. Inflation refers to the general increase in prices of goods and services over time. It erodes our purchasing power, essentially. When prices go up, the same amount of money that we made yesterday, we're making today, goes a little less far. Central banks, like the Federal Reserve, monitor inflation closely as it can impact economic stability. Rising inflation may lead to higher interest rates affecting various financial instruments, including mortgages. Now, there are 2 factors that impact mortgage rates. If you're in the market for a home, you've likely been following mortgage rates closely. They've hit lows, they soared, and now they're settling back down. But why does this happen? Let's break it down. The first factor that impacts mortgage rates is inflation and the Federal Reserve. We just learned about that definition. The Fed doesn't set mortgage rates directly, but it does influence them. By adjusting the federal funds rate based on factors like inflation and the economy, the Fed indirectly affects mortgage rates. If they raise rates to curb inflation, mortgage rates may go up. On the flip side, expectations of rate cuts, like we're seeing right now in the market, and decreasing inflation can bring mortgage rates down. Now, rates have been going down 4 to 8 weeks roughly at the time of the recording of this video. So that's what we're seeing today. Now, the second factor impacting mortgage rates is the 10-year Treasury Yield. Mortgage companies use the 10-year Treasury Yield to set interest rates on home loans. When yields rise, mortgage rates often follow suit. In fact, most of the time they do. Conversely, a drop in the yield tends to bring down mortgage rates. Now, monitoring the trend of the 10-year Treasury Yield gives insight into potential changes in mortgage rates. So keep an eye on that. Again, refer back to those sites that I just mentioned a minute ago if you are an analytical and want to just really kind of study this. So in closing and in summary, experts anticipate mortgage rates easing in 2024 as inflation improves. So keep an eye on the Fed's decisions and the 10-year Treasury Yield for insights. And of course, for professional guidance on navigating mortgage rate changes, having a team of professionals like me, like the Hollenden team, and the 7 members that are here to serve you, and the awesome lenders that we work closely with in the Louisville, Kentucky market, we're here to help you, and partnering with a team like this is in your best interest for the best professional move that you could possibly make. Thank you so much for listening, and I look forward to seeing you around town.